That life insurance policy you did from work, the one that's part of your benefits package, it probably feels pretty solid, right? Like it's a secure part of your financial plan. Well, here's the thing. I want you to think of it not as a solid structure, but as scaffolding. Yeah, scaffolding. It's incredibly useful while you're working on the building, but the second the job is done, or you leave that job, that entire structure gets torn down. Relying 100% on this temporary setup is one of the biggest hidden risks in personal finance. Let's jump into the first and maybe the most fundamental flaw in this whole setup, the portability problem. The idea here is really simple, but it's absolutely crucial. You don't own your work policy, you're just renting it. This slide really gets to the heart of it. See, with a group plan, your employer owns what's called the master policy. You're just a certificate holder. It sounds official, but it just means you have a piece of paper saying you're covered. But with a private, individual policy, it's the complete opposite. You own it. You control it. It's your asset, period. So here's the bottom line. Your group coverage is tied to your job, not to you. It's an employee benefit. That means when your employment ends, and I mean for any reason, maybe you find a better opportunity, you get laid off, you retire, that insurance policy stays with the company. And you can see the difference laid out pretty clearly right here. Group coverage is literally chained to your employment status. An individual policy, though, that's yours. It's an asset that follows you no matter where your career takes you for as long as you pay the premiums. It's your policy, totally independent of any boss or company. Now, you might be thinking, wait a minute, I thought I could take it with me. And you're not totally wrong. Legally, you usually have a right to convert the policy, but, and this is a huge but, you typically only have a 31-day window to make that happen. And as we're about to see, this so-called option is often a trap that leads us straight into our second system failure. Risk number 2. And honestly, this is where things get really dangerous. It's what I call the uninsurability trap. And man, this one catches so many people completely off guard. It's all based on this dangerous assumption that you'll always be healthy enough to get insurance later. But what if you're not? What happens if your health takes a turn while you're comfortably covered by that work scaffolding? See, to get a private policy, you have to provide what's called evidence of insurability. Basically, you have to prove you're healthy. So to really get this risk, you need to understand a core insurance concept called adverse selection. All it means in plain English is that people who think they have a higher risk of something bad happening are the ones most likely to go out and buy insurance. And to protect themselves from this, insurance companies use what's called medical underwriting to figure out the actual risk for each individual. But here's the kicker, group plans almost never require individual medical underwriting. You get hired, you're automatically approved. And while that sounds like a great perk, it creates this huge, dangerous blind spot. You could develop a serious health condition while you're employed, and because you're still covered by the group plan, you have no idea that you've just become potentially uninsurable on the private market. This is the trap in action. Let me just paint a quick picture for you. Imagine a professional in their 40s. While they're working, they get diagnosed with something manageable. No big deal, right? The group plan covers them. Then a few years later, a fantastic new job comes along. They leave. They lose that group coverage, and they go to get a new private policy. And that's when the floor drops out. They're either flat out denied, or the premiums are so ridiculously high there's no way they can afford it. They've just fallen headfirst into the uninsurability trap. Okay, on to risk number 3. And I can already hear some of you thinking, but wait, my plan has a conversion privilege. I can take it with me when I leave. And yeah, you're right. A lot of group plans do offer that. It lets you convert your group coverage to an individual policy without having to prove you're insurable. It sounds like the perfect loophole, right? Well, not so fast. It comes with a massive hidden cost. And here's the trap, plain and simple. First, this tiny little window, just 31 days after you leave your job, to make this massive decision. No pressure, right? And second, here comes the hidden tax. The premium on these converted policies are often shockingly high. I mean, we're talking 3, 4, maybe even 5 times what you'd normally pay for a policy. That plan that cost you maybe $50 a month at work could suddenly jump to $250. Why? Because the insurance company knows your health might have changed and they've got you over a barrel. And this part is so important to understand. Converting your policy does not mean you're just continuing your old plan. It's not like transferring your phone number to a new carrier. No, the insurance company issues you a brand new individual life policy. That is totally different and way more expensive, and it's pretty much your only option. The price shock. Well, it's shocking. Just look at this chart. Your premium can easily jump by 3, 4, 5 times, or even more. The new price isn't based on that nice blended group rate anymore. It's based on your attained age, which is just a fancy way of saying how old you are now and your individual risk. It's a system that's pretty much designed to be unaffordable. And that brings us to the fourth and final failure of the system, the benefit itself. Employer plans are designed to be one size fits all, which in reality usually means one size fits none. Just look at the difference in philosophy here. Group plans, they're built for the company's budget. They're built for easy administration. So they give you a generic benefit, usually just 1 or 2 times your salary. A private plan, on the other hand, is designed by you for your family. It's calculated based on your real needs, your mortgage, your kids' future education, your actual goals. You are in complete control. So after diagnosing all these system failures, what's the solution? What's the standard work, the proper procedure for building real financial security? It's simple. You have to shift your mindset from relying on that temporary scaffolding to building a permanent foundation. And this is what that solution looks like. The answer is to get your own private, portable, individual life insurance policy first. This becomes your financial foundation. It's the bedrock that protects your family no matter where you work, what happens to your health, or which way the economy turns. When you build this foundation for yourself, you own and control the policy. It's portable, so it goes with you through every single career move. It's customized specifically for your family. And maybe most importantly, your rate is locked in based on your age and your health. Now this is what real financial security looks like. It's a foundation that you, and only you, own and control. A private policy is a personal asset. You choose how much coverage you need. You name your beneficiaries, and it stays with you, protecting your family on your terms, no matter how many times you switch jobs. So let's just tie this all together, right? A private policy isn't just a nice to have, it's the direct answer to every single one of the risks we just talked about. It gives you true portability, so it follows you. It lets you lock in your insurability based on your health today, so you're not gambling on your health tomorrow. It gives you total control to pick the exact terms and the exact amount of coverage that your family actually needs. Now, does this mean your employer's life insurance is totally useless? No, not at all. The right way to do this, the correct standard work, is to see it for what it is. Think of it as a bonus, not the base. You build your own permanent foundation first with a policy you own. Then you can happily accept any extra coverage from your employer as some nice temporary scaffolding on top of our rock-solid base. So I'll leave you with this one to really think about. Is your family's financial house built on temporary scaffolding, or is it built on a permanent foundation that you own and you control? Scaffolding that your employer could tear down at a moment's notice, or have you built them a real permanent foundation that no one, not a boss, not a company, can ever take away?